Bruce Brumberg. I'm editor-in-chief and co-founder of MyStockOptions.com and MyStockPlan.com. We're a popular source of knowledge, content, and tools on all types of stock compensation and employee stock purchase plans. In this video, I'm going to be talking about taxes, and one of my goals is to help you make the most of your ESPP and make the most of participating, because I think it's great you're able to, and I think to do that, you're going to have to understand a little bit about the taxes. So let's go into what I consider to be some of the key points to know about. Now, I'm focusing on what's called a tax-qualified ESPP that fits into Section 423 of the tax code, and that's going to give you a little bit of a special tax treatment. It's the most popular kind of ESPP. It's the one where you're usually getting a discount, potentially a look back on the purchase price. Now, some of the rules, and the first three I think are pretty straightforward and you'll like them. There's no tax at purchase, there's no Medicare or Social Security tax, ever, even when you sell the stock, and there's no tax withholding. Now that all sounds nice. What gets complicated is that when you do sell the stock, you're going to have two types of taxable income. You have this ordinary compensation income, and you're going to have capital gains income. And this is the rule. I mean, there's a few exceptions to this, but generally, let's say your stock price has increased since purchase, so you're going to have these two types of income. Now, the breakdown between whether you have how much compensation income you have and how much capital gains income, that depends on how long you've held the stock for. Okay, so let's look at an example to try to make sense of all the rules. The stock price at the beginning of the offering period is $10 a share, and on the purchase date, the stock price is actually $12 a share. There's a 10% discount. You have a look back, so your purchase price is $9. And then you sell the stock at $14 a share. Now, to put all these rules to play, what matters is how long you've actually held the stock for from the date of purchase and from the beginning of the offering period. Now, if you sell the stock less than 2 years from the start of the offering period and less than 1 year from the purchase date, you've made what's called a disqualifying disposition. Disposition has nothing to do with your temperament or your mood. When you actually sold the stock, it has to do with you've actually gifted or sold or gotten rid of the shares in some way. So in this situation, you're going to have ordinary compensation income based on the spread at purchase. So the difference between that $12 price and the $9 price, it's going to result in $3 of ordinary income. And then you actually sold the stock at $14. So you're going to subtract from the $14 your $12 tax basis in the shares, and you're going to have $2 in capital gains income. Now, in the next situation, you make what's called a qualifying disposition, so you're going to be in a better mood for this, because now you've held the shares more than 2 years from the offering date and more than 1 year from the purchase date, and you're still going to have ordinary compensation income, but it's going to be based on the discount at the beginning of the offering period, even if you didn't have a look back. So you have that 10% discount, you have the $10 stock price at the beginning, you're going to always have $1 in ordinary income no matter how long you have held the shares for. Then you sold the stock, remember, at $14. So you have a tax basis now on the shares of $10, which was your purchase price of $9, plus your $1 in compensation income. You subtract that from the $14, and so you're going to wind up having $4 in capital gains income. So you have $1 in ordinary income, $4 in capital gains income, less ordinary income and more capital gains income than when you sold the stock earlier, and then that's going to result in lower taxes for you. The compensation income in both these situations are going to appear in the W-2 in the year of your stock sale, and you're going to get a 1099-B from your broker that's going to report the sale proceeds. Make sure you fully report this information on your tax return, even if you've sold all the stock right away at purchase. Well, thank you for watching this video series, and for more details on ESPPs, including many more tax examples when your stock price is going up and down, financial planning ideas, tax return reporting, look in the ESPP section on MyStockOptions.com, or if your company licenses content from us or your stock plan provider does, look in the ESPP section, the Knowledge Center, and should you want a custom version of this video, email us at info@MyStockOptions.com.